If you were to invest $1 in Berkshire Hathaway in 1965 and held on to it for 54 years, by the end of 2019, your $1 would be worth $21,594.54. That is a compounded annual gain of 20.3% and an overall gain of 2,744,062%. Compare this to the S&P 500, which had a compounded annual gain of 10% and an overall gain of 19,784%. In the past 54 years, Berkshire has dominated the S&P 500. But what I want to focus on is what Berkshire Hathaway has done in the past 10 years, or what they have failed to do. Let's start off with the numbers. I decided to go with 7 key financial data. I could do more, but I wanted to simplify it. Let's look at the operating cash flow. This is the only net loss that these numbers have. In 2017, Berkshire Hathaway had $45,728,000,000 in operating cash flow. By 2019, it ended with $38,687,000,000 in operating cash flow. That is an operating loss of 8.02%. Now all the other numbers look fine. The debt to asset ratio is around 0.50. That is a conservative number. That's something you'd probably see with someone like Warren Buffett and Charlie Munger, who are conservative. Really, the operating cash flow, it's only bad if it keeps remaining negative in the future years. And then you start to see the debt to asset ratio go up, cash and cash equivalents go down. That's when that's bad. That's when you have a deteriorating balance sheet. In operating cash flow, that'd be a deteriorating cash flow statement. But a mixture of both those is bad. The diluted earnings per share is for the B shares. And the net earnings, I decided to use GAAP accounting. Warren Buffett disagrees with the recent changes, but I'm going to use it anyways. Just due to the fact that how fast they lost money in the airline stocks kind of proves that, the stock gyrations kind of matter. He had to sell at a loss. I think some of the reason why he doesn't like the new GAAP accounting is that it could potentially draw more traders in to his Berkshire B share. I don't think there'll be a lot of traders trading his A shares. You have to have a lot of money to do that. But the B shares, I can imagine those potentially being more volatile in the next coming years. And I know he doesn't like traders trading his stock. So the numbers don't look half bad, but that is just a quantitative approach. Let's go look at the qualitative approach. I have 6 bullet points for the pros and 4 bullet points for the cons. And I just wanted to go over the important bullet points, or the ones that I find are the most important. So for the pros, you're investing in a high-quality insurance company like Geico. And the reason why I picked Geico instead of one of its railroad companies is because Geico has insurance float. This is one of the key competitive advantages that Berkshire has over any other conglomerate. So when you compare Berkshire to 3M, you're essentially comparing an insurance conglomerate to just a regular conglomerate. At the end of 2019, Berkshire had $129.4 billion in insurance float. There is no company that is as big and diversified as Berkshire Hathaway. You can't find a company that has been in railroads, to clothing industries, to candy, to food, to quality dairy. Warren Buffett has been in every single industry but tech. The few times he has been in tech, he unfortunately went with the lesser kind of tech stocks that you could buy at the time. So IBM would be one of them. Right? He bought IBM instead of something like Apple. Berkshire Hathaway has 250 million shares of Apple. Now I heard that it wasn't Warren Buffett that originally bought this. I heard that many people were constantly telling him that, hey, you need to buy this stock. And they kept drawing it to his attention until finally he bought it. And they must have really kept convincing him to buy it. It must have been someone like Todd Combs or something that bought it first and then eventually they convinced him to put more money into it. If Berkshire Hathaway can get into tech, it would unlock growth that Berkshire Hathaway has never seen before. And I hope one day they do unlock that, because I think that tech is the most profitable industry there is. Next to probably something like insurance. You could say pharmaceuticals are up there too, but pharmaceuticals I think are going to get in a lot of legal trouble with price gouging. But tech and insurance companies, they're up there when it comes to making money. Let's look over some of the important cons. So Buffett recently lost a bunch of money in the airlines. This is the second time he's done that. Berkshire Hathaway reported a net loss of $50 billion in Q1. Now, not all that was due to airline stocks, but a good portion of it was due to that. I could see the logic. I guess recently airlines were producing a heavy profit that they haven't produced in years. So it suckered a lot of people in, plus the fact Warren Buffett was buying into it, suckered more people into it. I tend to stay away from airline stocks and automobile stocks. You could argue the same thing about banks. Banks don't tend to do good in recessions, but I think banks have improved. I think their lending process is more disciplined. Now, it could still be a problem because interest rates are low and they're more disciplined with their lending. So you could say less income, but I'm probably more of a bull than a bear in that case, in all honesty. But like I said, maybe Warren Buffett should think more about investing in tech or maybe even more insurance. I could see how he doesn't want to invest more in more insurance companies, though, because he could be accused of antitrust laws. Warren Buffett will turn 90 at the end of August, and his partner Charlie Munger turned 96 in January. So now with this, you run the problem when they pass away that the next person that gets in line for the CEO will try to be overly greedy. I mean, why would he pay himself $300K a year? He doesn't have billions in Berkshire stock. So what you might end up seeing is someone paying himself $2 million a year plus tons of Berkshire stock. You could see something like that. And if he doesn't do it, the next person after him might do it. Sometimes it takes 2 generations for a company to get just slaughtered due to CEO greed. Given the size of its operation, Berkshire's biggest hurdle will be its ability to consistently find deals that not only add value, but are large enough to be meaningful. Warren Buffett and Berkshire Hathaway, they can't just go invest in a bunch of small cap stocks. They're limited to about probably 100 stocks that actually could be meaningful to the business. So this limits his ability to find companies that will grow over a 20-year period at an exceptional rate. So some kind of growth rate of a 20% or a 15% compounder. Even a 15% compounder would be good. But it'd be hard to find a company that consistently grows at 15% and is a very giant big company. That doesn't tend to happen very often. I think in the next 10 or 20 years, if the next CEOs are not greedy or overly greedy, I think that Berkshire Hathaway, even if it doesn't go into tech, let's say it invests more time in credit card companies and banks and insurance and maybe even real estate, if he decides to go big in real estate, can outpace the S&P 500 by a little bit. I don't see them keep growing at 20%, but even if they could do it at 12 to 15%, you would do better. And I could see that. So I think Warren Buffett's stock, Berkshire Hathaway, is still a buy.